Friday's labor report came in better than expected, and the S&P 500 caught a quick pre-market boost straight into the 6,000 call wall. The trouble is, it just stayed there all day and it was unable to break above. Now that, paired with some subtle bearish divergences that I'm seeing, makes me cautious of chasing new highs, but the signals aren't quite bad enough for me to want to go out there and short the market into the ground. So welcome back to the Trade Brigade Weekend Show, where we'll take a look through all of the data points and we'll build a logical trade plan. My name is Matt, and if you're new here, hit the thumbs up button and subscribe. For additional resources, check out the links listed down below in the description, and stay tuned until the end of today's show. I've got 3 additional trade ideas to share with you that you won't want to miss. With that said, let's jump right into the charts. So we'll kick things off on the SPY weekly time frame chart, talking about candle structure and location as we always do. In terms of structure last week, solid green-bodied bar with a very impressive close from the buyers towards the highs of the weekly range. Not much in terms of wicks to read into here, so buyers definitely get the check mark in terms of structure. If we're thinking about location on the bar-to-bar count, a clear bar-to-bar higher low as well as a higher high, and a close completely outside of and above the previous week's range. That's 2 for 2 on the bar-to-bar count for the bulls in this market. If we take a look at what's happening with the weekly trend, though, we know that this was a 3-week balance range in the box. We've finally broken out and closed above the top end of the balance range highs, continuing to pressure the weekly chart and offering some semblance of a new higher high. I'd certainly start referring to that higher high more importantly on the daily time scale, and I would still give the weekly chart the benefit of the doubt even if it were to come in and close this gap all the way to the downside here around 570s, slightly overshooting 570s. That would not be the end of the world. Why? Because the daily trend never flipped to down inside of that red weekly bar right here. Therefore, we do not have a firm weekly higher low at the bottom end of the balance range here. So the weekly trend is up, the buyers are in control, and we're breaking out of a 3-week balance range. If we were to double this range in the upward direction, a simple measured move sort of takes us straight up into the all-time highs. That, of course, is bullish. So once again, no issues. The bears absolutely have the burden of proof on the weekly time scale, and I'm not seeing any evidence here that they're really stepping up to the plate trying to offer any form of a reversal. If we come in with the Fibonacci's from the low up to the new high here, notice that the Fib 38.2 is still underneath the full gap fill. Again, that's a bullish data point here, meaning that even if the weekly chart came all the way back down to something like 554, 555, it could still qualify as a higher low. The level that we've been really adamant about is this 551 coming from this previous support low over here. It wouldn't be ideal, and it would bring in complications if the weekly had to pull back that far. Of course, the threat would then become some sort of lower high underneath, something like the balance range lows. But hang on a second. Let's just pause. Let's take a deep breath. Does this seem like a top priority given the weekly close outside of the 3-bar balance range here that we've just described? I would certainly answer that question with a no. If we come in from the top down to the low, of course, we're still well above the Fib 68.1, which would improve the odds of a 100% retracement. Let's clear that up. Let's take a look at our weekly anchored VWAPs here on the S&P. We're above the entirety of the cluster. There's really not much to say for the bears. Buyers are in control. What about the volume profile on the weekly time scale? Let's see what we can see. Let's take a look off to our left. There we go. Where did we land relative to this high volume node? We've certainly got a weekly close above. Once again, buyers are totally in control of the weekly timescale. Let's drop this thing down to the daily timescale, where we start to see some subtle divergences. Nothing that makes me overly concerned, as we said in the intro, but we'll go through it in just a moment. First things first, weekly expected move is this box right up here. If you're not familiar with this study, check out the video tutorial in the top right-hand corner. If we're contained by the upper bound, the number is at 608.41, and that is, of course, implying a higher high. If we're contained by the lower bound, the number is here at 589.87, and it's still, in my view, some semblance of a daily higher low. As a matter of fact, what I'm going to do is I'm going to simplify our daily chart to look a little bit cleaner, a little easier on the eyes here, and what we know is that this is the weekly balance, right? That's what we just broke out of and closed above on that Friday session. So on the S&P daily time frame chart, there's really no reason to be overly concerned about strong downside unless the market were to fall back down underneath something like 550 559.15. And I'm leaving this zoomed out for a reason because I still want to reinforce the importance of this level as well. At 599.25, it's the upper wicks of this bar where we firstly started to roll and break down underneath the daily 50 SMA. That's the blue moving average on the screen. If we can't break out up and over that, and then, as a consequence, right, we do end up falling back down into the range here at 595.15. Let's say we look something that looks like this. I'm, again, not outright bearish, oh my God, we need to short the market into the ground, but I don't think it's really quite worth chasing the market here at the highs if we are rejecting this level, which was also this previous area of support. Once again, that's 599.25. So, where are some of these divergences that I speak of? I mentioned it in the intro. It comes from our market leaders. We have a new set of market leaders, right? If you take a look at Apple, just as a quick example, is Apple helping pressure the S&P back to the all-time high? The answer is simply no. I'm not going to say Apple is like a dead company and oh my God, let's avoid it like the plague, but it's not performing. It's no longer a market leader. So who are the market leaders right now and what are they doing? Well, I've conveniently popped together this list. Right? We had Broadcom, the first semiconductor name to go on to produce brand new all-time highs. What did it do on earnings headed into Friday? Right? It's sort of rejecting these highs here, starting to pull back. Now, am I saying that Broadcom is going to collapse, go to zero, and bring the broad market with it? No, but it's not continuing the move into blue sky territories post-earnings. If I zoom in here, you can see it's actually pulled back underneath the previous all-time high. So one of the divergences that I'm talking about, and we'll see this when it comes to market breadth as we get deeper through the analysis today, is your names like Broadcom pulling back below previous all-time high. Not unreasonable if Broadcom comes all the way back to something like 234.25 for a Brigade bolt, right? The classic pattern is you break out of the balance range, huge new excess high. If we come in here and can suggest a higher low, it's just a Brigade bolt. So we're looking for 234.25. So to get there, of course, that would imply some subtle downside pressure from a new market leader in the S&P 500. What about Robinhood? Of course, this one was massively disappointing, right? And of course, the news after hours would confirm that it's not going to be included in the S&P 500, but it's down after hours around 70.20, 70.21. So that puts price on a big gap down for Monday morning, very likely. Generally what this would imply to me, sure, it's not in the S&P 500 itself, but it's a new market leader pushing markets, the sentiment of markets in the upward direction, offering a little bit of a gap down for early on this upcoming week. Even if you just look at the candle structure, look at these large upper wicks on Robinhood back to back from your Thursday, Friday session. People very, very reluctant to commit new capital up there towards those highs. What about Palantir, right? We obviously saw the news on Thursday. Large drawdown starting to look a little bit more so like a double top. I'm not going to say it's completely confirmed and triggered until we actually get acceptance under the neckline, which would be at 121.25. However, bring this back to why we're talking about these leaders. Is this helping the S&P continue over new all-time highs, or does it start to look a little bit more like a distribution range here, and could Palantir cool off? I mean, you could say this about a number of these names, right? CrowdStrike's a little bit better. Post-earnings, it actually did catch itself for support over the key level at 450, so we'll give CrowdStrike the benefit of the doubt. Uber has certainly been a new emerging leader. Look at this rally here as the market sort of staged the move off the lows. Uber is pretty close to, again, getting back up towards its highs, or it's trading near its local highs. You can see the pullback, right? It's off of its highs currently. So as a new leader, sort of acting as a little bit of a laggard here into the end of this week, maybe we're sort of, again, not willing to chase those highs in the S&P 500. GE Vernova, mild little pullback here. Of course, on the nuclear front, what about CoreWeave? Starting to get a little bit of that parabolic blow-off top look. We have an inside bar on Friday. Again, if it were to pull back, is this going to pressure broad markets lower? Perhaps. Even Netflix, which is just, this one is such a head-scratcher to me, but we'll let it be. Like, it is what it is. Netflix to new all-time highs, starting to pull back a little bit on that Friday session. The point of the exercise in going through these new market leaders is we're looking at the S&P 500 hanging out with a little bit of an indecisive doji-esque style look here, failing to really accept quite yet over previous overhead supply. We've gotten a break out of the balance range, but all it takes is a subtle little rejection of 599.25, and we're still somewhat, again, not outright bearish, but somewhat neutral inside of the balance range here. If you have a little bit more aggressive of a take than I do, which would be, okay, this is a classic look above and fail. Look above, fail back into the range, lower high in range. I mean, you could try to short this back down to the bottom end of, this was, I believe, The court ruling gap, I'm getting lost with all the different tariff catalysts, earnings, all this different stuff. But the EU, crazy amount of stuff going on to keep track of. But you could use that as a potential target if you wanted to try for risk reward along these lines here. I just wouldn't overstay my welcome on the bear side until the daily trend actually flips to down. Recall on the weekly time scale just a moment ago, we were talking about the breakout of the 3-day balance range forcing a higher high. It's really a higher high on the daily time scale, right? You still have lows, higher lows, soft higher low in a box, soft higher low in a box, soft higher low in a box. This is a firm higher low. We talked about that via the hourly downtrend here, and you finally breached and exceeded this previous high, which once again means we have the higher high in the trend count. So can the market afford a higher low pullback? Is the market still bullish? I would absolutely answer that question with a yes. The market is still bullish. There's still room for a higher low. I just don't know if I'm allocating capital at the tippity top of the move, right? So you got to be very cautious of that. So what would it look like if we're going to get involved on the highs looking for follow through towards the all-time high? I would really love to see the market extend the gain a little bit further in the as the first attempt, then pull back, hold this, confirm this as a better higher low outside of the previous pivot high, and then get that rotation into the all-time high. Now, do we get that beautiful little rotation there? It's yet to be seen, but for now, with the indecisive doji at a known area of resistance, not quite pushing into this thin structure yet, I'm just being a little bit cautious of going overboard on the longs at the top end of the move here. If we take a look at the hourly time scale, we can start to get granular and build out a game plan. You guys, let me know in the comments section as well. Was that exercise as looking through the new market leaders, was that useful? Was that, how did you feel about that? We don't typically breach from the S&P analysis while we're still talking about the S&Ps, but give me some feedback. We can maybe do it again in the future if need be. You could see the indecisive action on Friday just totally pegged at that 6,000 call wall. There's some really, really solid traders up there in the pre-market prep up in the office who have been suggesting, hey, maybe start looking at that a little bit more seriously. And of course, 6,000 was indeed the call wall. It's where the market pinned on Friday, and we didn't really go anywhere. So pathing outcomes as we walk forward, again, it's not bearish to me. If we're just, let's say the market pulls back and we're over this previous pivot high, I don't really see that as an issue, right? So I'm not even look above and fail if we're pulling back over 590, 515. This is a possible place for really quick scalps, like risk reward like this. But if you've been trading this market, right, you've sort of seen how the market was really brutal to trade inside of this range, just choppy, sloppy back and forth. And then even this week, it started to get brutal on Wednesday, Thursday, as this range here was developing. So is this the strongest long opportunity that I've ever seen? And oh my God, we've got to take that opportunity. It leaves a little bit to be desired, if I'm being honest. It's still definitely a higher low in the hourly trend count. We have lows, higher lows, higher lows. It's an hourly higher low undoubtedly at 595.15. But is it going to be a, quote, easier trade to take, or is it going to be difficult battling back through this chop and slop? I think it probably falls on the difficult side of the spectrum there. So if we are going to get that follow through in the upward direction, once again, it would probably require a little bit of an extension first, pull back higher low here. Now, if we can get something over 599.25 for risk and reward towards the upper edge of the weekly expected move, certainly with respect to 602.50, 606.75 is a level in there as well. If we can get this risk reward, though, that's a, quote, easier trade to take than battling through all of these positions that are being held from this little range in this zone right here. Okay, so that's my upside preferred game plan, which would be some extension early on in the week that pulls back and then offers a re-entry long to look like this. If the market pulls back here, it's not the end of the world. I would still very much so entertain this idea in the upward direction. If we fall back down underneath 595.15, this is where I'm just like not interested at all in touching the market through this as a consolidation range. Yes, it starts to trigger that higher time frame daily look above and fail. If you really want to press the bet, you could try risk reward shorts along these lines. So short risk in that box, reward back down first to 588, and then beyond that, right, you're really trying to extend those shorts into the top end of this gap here. Now, whether or not you get there all the way, I'm not fully convinced. So, to go back and cite the divergences, the bearish divergences that we've brought up, I'm not thrilled about shorting the market on these data points. I'm more so just like open-minded to, if this takes place, if this, let's just label this path number 3, this would be 2, and this would be 1. If path number 3 starts to unfold, I'm not going to be sitting at my desk like draw on the desk, oh my god, I can't believe the market's pulling back into the range, right? It's very reasonable given sort of some of the things that we'll see here in today's episode. So that is what we've got on that front. Let's quickly come in here with the fibs from the origin of the move to the top end. Fib 38.2 is smack in the middle of the range. Not really a big fan of that. That's not really telling us much. I would say we could come in from here as well. Oops, let's get a click from Thinkorswim up to the highs. Fib 38.2 is fairly close to that 595.15 level, which in my view would just classify this as bull flag consolidation, right? This is fine. And then over time, we're still looking for that follow through move in the upward direction over the 599.25. So all set on a fib perspective. Let's quickly check in on our intraday anchored VWAPs just to give you some orientation here. The tariff turmoil, Liberation Day, this is the all-time high. Then you have the anchor to ultimately the 90-day pause, the first announcement of the 90-day pause, this fake out, and then the gap up that really kicked off this new leg in the upward direction. So where do we land relative to all of these? We're above the entire cluster. So as I said in the intro, the bearish divergences are not really enough to make me want to go out there and short this market with both hands. Oh my God, we should be swinging for, let's close the China gap. Let's really get down here towards 567.75. Like, put the brakes on that idea until, number one, at like bare minimum, you'd have to be underneath 595.15. Secondly, I'd probably need to see a breakdown if this is going to be like a higher high double top now. Something that looks like this under 577 to get into the gap in the first place. You can also see here 588. It's the lower edge of the weekly expected move. You have the anchored VWAP starting to cluster around that from here as well as here. It doesn't strike me as like a great spot to be initiating big new money shorts. It seems more supportive or congestive, if anything. Like you're just going to get clogged up in this zone here. Not really going to get follow through to the downside in a big way. You would need some sort of big outside catalyst if that was going to be the case. And dare I bite my tongue, we do have CPI this Wednesday at 8:30. So that could possibly do it. However, I don't know that an increase in prices is going to be reflected in this report that we get Wednesday. We'll talk more about that in just a moment. Some more supporting evidence that, again, keeps me away from thinking it's a big short here. Let's take a look at the market internals. If you're not familiar with this dashboard, check out the video tutorial in the top right-hand corner. What do we see this week? Well, certainly on the days where we did get follow through in the upward direction earlier on in the week, and even just a hold higher on the Friday session, notice big volume inflows, net flows on the week, up around 480 million. That's a decent read. It's not quite over the 500 million threshold, but getting pretty darn close. The advanced decline line spent most of the week in trend higher zone, or I should say, not in trend higher zone, but over the zero mark. It would have been better if it was in trend higher zone, as a matter of fact, up here over the 1500. The index score for the most part this week was over the zero mark, confirming not really a divergence there. We'll get more to the divergence when it comes to breadth momentarily. As we look at the cumulative build out of the tick, strong move on Tuesday, which was really the day where the market made the most of the advance there, and then on Thursday as well, a little bit of that spat and end of day with the Tesla turmoil. But I think the takeaway here, right, is if you're concerned about the Tesla spat and what's kind of happening broad market-wise, look at your cumulative build here. Look at your sort of index score is going to even show us mild downside, not even sustained all day. The advanced decline line just gets back to the zero line. What I'm sort of referencing is that it seems to be an isolated incident with Tesla and Elon and the administration and the whole nine yards. It's isolated to Tesla. It's not spreading market wide where, oh my God, everybody's freaking out and everybody's turning against each other and it's this mayhem in the market, broadly speaking. It's just kind of the two as an isolated event as of right now. So that is your market internals reference. We'll quickly come in here with our market profile. If you're not familiar with the market profile, here's another video tutorial for you in the top right-hand corner. Feel free to check it out. What do we see here relative to value area and point of control? Here's Monday. Tuesday certainly gets follow through. Clean value in the upward direction. Obviously a breakaway with the point of control. Wednesday gives you a consolidation, but still value is higher. On the Thursday breakdown, one thing that I find pretty compelling here is that value did not substantially shift lower. Right? We broke underneath the Wednesday low, and yeah, the point of control is underneath, but look at where value is, which represents 70% of the day's volume as distributed from the point of control. It's, for the most part, over the Wednesday low. You could even see an L period here. There's a really great excess low where that L period marks the proper end of the auction. And of course, on Friday, where does value migrate again? in the upward direction. So you could read this really two ways. The preferred way I'm reading it is that people are willing to sort of allocate capital at these higher prices. It does mean if the market pulls back, right, you have trapped longs from here, you have trapped longs from here, trapped longs from here. So what it would really take, in my view, is really a breakdown underneath something like your 59.60, 59.55s, underneath the value area from the Thursday session might open the door for a little bit larger of a breakdown. But as we can see, and as we just talked about on the S&P 500 cash chart there's really no reason to think that that breakdown is coming unless you're underneath the key level. So, 59.60, 59.55, if we just quickly flip back over here, that would really just be the equivalent of the Wednesday low, which is at 595.15, the level that we just talked about until we were blue in the face. So all set on the S&P 500. Again, a little cautious of the new money longs up here without some sort of confirmation first and then a pullback with a better entry. And if we do just fall back down into range, just kind of taking it easy, not really pressing the bet on the short side in a big way there. Let's take a look over at our good friend, the QQQ NASDAQ 100, nasty NASDAQ. What do we see? Let's go up to a weekly time scale. And let's bring on the top-down analysis. Clean set first. What do we see here? So candle structure and location, just like the S&P 500. Solid green-bodied bar, very minimal wicks. We did get so again, that's bullish, strong close there. In terms of location on the bar-to-bar count, certainly a higher low and a higher high, and a close as well, up and out of the balance range here, which was really more of a 2-week balance range. Recall that last weekend we had described the upper wick on the QQQ weekly bar being slightly more concerning than the S&P 500, a lack of acceptance over the previous 2 weeks highs. Well, I mean, what is the classic short setup? Well, you have to be underneath the inverted hammer low, and we just never got anywhere close to that in this last week's worth of trade. Just like the S&P 500, I would still give the NASDAQ the benefit of the doubt if it wanted to pull back to here, close the weekly gap, and offer a weekly higher low. I would still give the NASDAQ the benefit of the doubt all the way at this level as well, although once again, it would provide complications. Something like this would be a much higher probability than, of course, just a gap fill reversal. Something that looks like this, the second arrow set that I just drew, higher probability, this becomes more of a reasonable threat. Once again, why should we bother speculating on that right now when the weekly bar looks like what we just described, solid green bodied bar, close over the previous weekly high, higher high, and a higher low on the bar to bar. We're much closer to the all-time high here in the NASDAQ, and you can see a range double does get us there, and we are well on our way. We have what seems to be a successful breakout on the weekly time scale, looking for that follow through in the upward direction. Again, just being a little bit cautious. If you're not already long the NASDAQ, if you're not already long the S&P 500, chasing the highs here, well, we just saw those divergences in primarily the tech sector, so we might just want to take it easy. Again, chasing longs at the highs if you're not already. Let's take a look at the Fibonacci's from the lows to the most recent highs of this move. Perfect. Well above the Fib 38.2 on the gap fill reversal. No issues there. And of course, we're well above the Fib 68.1, and we are on our way towards that 100% retracement. Not much to talk about on that front. We can quickly reference the anchored view apps. We're above the entirety of the cluster here on the weekly. And of course, our volume profile, as we zoom out, is one volume node that we care about, and we've been breaking out above that the entire time. If we check in on this high volume node, would you look at that? Even above the upper high volume node. So if the market pulls back on the weekly, buyers, of course, would want to stay above that node to prevent overhead supply from potentially folding and causing a little bit more firm sell side activity. That high volume node is at 520, 521, if you want an exact number here on the QQQ. As we know, it's really going to be the top end of the balance range. Let's reset this chart and go to the daily time scale. Let's throw on that clean drawing set, the daily version of the levels. We'll put the hourly levels on when it's appropriate. Weekly expected move is this box right here. Upper edge is at 540.19. That's a new all-time high. Brand new Let me actually double check it up against this high. High 540.81. So just shy. My apologies. We're shy by about, let's just use some quick math there, about 60 cents shy of this true all-time high, but the top end, right, of what could be considered a little bit of a double top, right around in there, around 539. The downside, the lower edge, the weekly expected move, 519.65, implying a higher low. I would prefer that the NASDAQ does not come back down underneath something like 522.50, which represents, if we just zoom in now, that we understand those left side reference points, It is the top end of the 2-week balance from back here. This is the upper wick from not this previous week's bar, but the week before that. And this is the successful close up and over 522.50. So as long as we're above it, no problemo. This was the pullback higher low hold that we were talking about in the Wednesday video. Did you panic? That was the title of the video, right? Don't panic. I was saying like, hey, it's all good. If the market comes in and gives a retest of the top end of the range, perfect, all set. Now it's just a matter of either you grabbed it long off that low and you're feeling good and you can manage risk just below, or if you're not long yet, you're probably looking at maybe an inside bar breakout. Notice that in the NASDAQ, you've just got an inside bar here. If you take out the high and get something along these lines, that could develop some range expansion for a trade, something like this, into the all-time high, over 533.25. 539 would be the target that I primarily use. Any consolidation that pulls back here, I would still be looking for support off of 522.50. Might be a little harder to trust the more times we test it. Here's test 1. I would give it probably one more firm test on the daily, then I wouldn't really want to see the markets testing 522.50 again. Probably spells a break back down into this chop zone, which is just completely avoid at all costs. Is brutal trading inside of this box here. Would not want to be involved. Where the shorts start to step up, probably under the bottom side with a lower high here at 515. That's a pretty big extension through the lower edge of the weekly expected move. I'm not saying it can't happen. Again, we do have CPI as a potential catalyst this week for some larger movement, but it would require, right, for me to change my tone on the QQQ daily timescale, I would need to see prices with a lower high underneath 515, the bottom end of this range from right over here. That traps all of these traders as overhead supply, and then I become a little bit more confident, okay, it's possible the trend is changing. Maybe we start to think about the China gap coming back down into play. I mean, again, look at the expected move. I'm not saying it can't happen. Anything can always happen in the market, but if we're playing a probabilities game, I would think this is lower odds for the coming week's worth of trade. What else on the dailies? Let's come in here with a trend line just because it's a little bit cleaner than the S&P 500. I'm not a huge fan of trend lines, you guys know that, but something that looks like this, right? We are still above the trend line, and early on in the week, it will be super support confluence with that 522.50. If you do want to see it with the S&P, let's just go over here for the sake of congruency. Let's come in with our trend line off the low, and you're just riding it, right? You're really riding that trend line quite closely. Here's the origination. There's the anchor. You could see this came above it, certainly there. These lower wicks are holding. Honestly, Friday's low probably is it, and once again, that 595.15, that just holds the key. So trend line and horizontal level in confluence, reinforcing the idea there. To stay on the topic of the NASDAQ, though, let's go down to the hourly time scale. And let's see what we can see here. Some more nuanced levels for the technical traders out there, those who are active on the day time frame. What do we see? So I would certainly be bullish in this consolidation zone here, under 533.25, over 529.75. Brigade bolts out of the range, bring us to the all-time high. If we do see some consolidation that moves a little bit lower, not as interested in here, although it technically is an hourly higher low, right? You have lows, higher lows, higher lows. If the hourly wants to do this and sustain, you're still in an hourly uptrend, suggesting that higher low, looking for the Brigade bolt over 529.75, which is really the Wednesday high, right? And it's also very close to the Thursday opening print. We sort of accelerated underneath that on Thursday. If we can get back above that, again, these two outcomes here, longs and longs, they're all right. But again, the most attractive long is just show me this, and then we're rocking and rolling over 533.25. Not interested in buying the pullback. Well, again, it depends on your time frame, really, of execution. If you were to get a pullback again on the daily into that 522.50, it's not that the level is no longer good. It's just that this test probably shouldn't be revisited. If this was it, and okay, we had the catalyst, we had the Elon Musk and Trump tit for tat spat. If that's going to be it, we shouldn't go back there. And the market should find support, consolidation higher, trying to get follow through from this move. So although, yes, maybe if it cleans it up and does something that looks like this and then builds out new structure, it's probably just a slower grind in the upward direction as opposed to a snappy V-shaped recovery where, you know, you get something that looks like this and you're immediately back over 533.25. So if we do come in for the test, 522.50, it's still key support, but expect a slow and steady grind through some of this mess on the move back higher. If we're under 522.50, you do start to trigger that look above and fail, meaning it's not even a look above and fail at this point because we do have a successful breakout of the balance range. A successful breakout usually doubles the balance range. We've more than done that. So it's no longer really a failure. It's rather just the possibility for a trend reversal, right? You could start to come in here and say, okay, if we're under 522.50, getting something that looks like this. Is this maybe a head and shoulders? It's possible. I wouldn't really speculate on that too much until the trend actually reverses and we do see the lower right shoulder beneath that 522.50. We're just not there yet, and for now, buyers are in control. We're just cautious of buying the high until there's a clean way to manage risk. I'd say the bottom line here on the NASDAQ and the S&P is if we are going to try to trade this into the all-time highs, we just want to be very certain that we have a clean and well-defined stop loss, and we're not just chasing this for the sake of chasing it as we're headed literally into resistance, right? If you're a buyer here before the break and you're playing the hope card basically that, okay, I'm hoping that it will break, I don't really think it makes sense with the divergences we've pointed out already in today's session. So that's the QQQ NASDAQ. Let's quickly come in with our Fibonacci's from the low end of this move up to the top end. Look at that. Fib 38.2 is literally right at the 522.50, reinforcing that as a key level. If we come in from the bottom here up to the top, the 50% retracement is there, and the Fib 38.2 honestly would keep me on the bull side still. Remember I was saying if we got something that looks like this, we have an hourly higher low from here, and then here. So over the Fib 38.2 does make sense as well to continue to lean into that bullish thesis that we've set forth so far, just being really cautious of buying at resistance, basically considering everything we've covered so far, and there's more to come. Let's take a look at, I guess we can go intraday anchored view apps to be completely congruent. You could see that we are getting a little bit of confluence around that 522.50. That's from these on the major gap up post the China move, and these ones below us from all the other anchor points, same ones as we talked about in the S&P, are still just slowly grinding higher. All set, we're above the cluster of fibs. Let's come into the market internals for the NASDAQ side of things. Let's see how we fared here. Definitely getting strong volume inflows on that Friday session after we saw some volume outflows on the Elon Musk drama, if you will. You can see up here, trend higher zone on the Friday session, and the cumulative build is pretty flat. This to me is another indication to say, okay, as the market's coming into maybe some heavy call walls and you have options resistance up there, you have some divergence at the exchange level, a little bit more so, a little, not much, but a little bit more so on the NASDAQ than the S&P 500, which had a slightly stronger build in the earlier stage of that Friday session. You're still getting confirmation on Tuesday as that primary segment of the rally took place in the upward direction. So there's definitely not stronger sellers stepping up at the exchange level. We're just cautious of buyers getting tired towards the call wall with some of these divergences in the new market leaders. Let's take a look at the market profile for the NQ and see what we can learn from this perspective over here. It's very similar to the S&P where your value is completely higher on the week. This is Monday, Tuesday, Wednesday, obviously Thursday, and then Friday inside of the Thursday session as well. So acceptance is definitely higher here. Once again, another indication to not go out there and just short this with both hands. And where would the short probably come into play? Maybe underneath the value area lows in here around 21,650s, 21,630s. Underneath maybe your Wednesday low becomes a little bit more compelling. We shall see. Even at that, I would still use the top end of the balance range, which if you've been following along in the pre-market preps, we know that level very well. It's 525 plus or minus 5 here on the NQ futures. Let's just make sure we can get it. There we go. 525 plus or minus 5. All right. That's it in the NQ. Let's take a look over at the Russell. Let's just preload this, I suppose. We'll go over here. We'll give this a little reset. And we will take a look at the weekly time scale. Really important move starting to unfold here in the Russell with the weekly breakout. Let's go to a weekly chart and let's have a look. So on the weekly time scale, I guess let's keep it congruent. Here we go. Candle structure and location. Solid green bodied bar closed literally on the highs of the weekly session. Lower wick indicating buyers stepping up on a slight undercut of the previous week's low. So on the bar to bar count, you do have a lower low, but you have a substantial higher high. Close above the previous week's range. Strong close literally on the highs of the week. And most importantly, notice how this is finally a little bit more of a confident push to a higher high, which on the daily chart we'll see as a little bit of an inverted head and shoulders. So why is this important? Because if the breadth and if this divergence that I've been saying so far is going to be absorbed, so to speak, from the broader cohort of the market, and if participants are still going to remain bullish overall on U.S. equities, be it small cap or mega cap, this could dampen any blow that we see in the S&P, which is one of the reasons why, once again, just because we have the true new market leaders coming in a little bit as the market's trying to continue to extend the gain out of the balance range, you've got the Russell saying, hang on a second. This is like almost, we talk about sector rotation often, but we don't really talk about like market cap rotation, if you will. I don't even know if, it may not really even be a thing, but the point being is it's not like all hope is lost. You are still getting some names out there catching a bid, namely in the small caps on the trigger of this inverted head and shoulders reversal on the higher time frame. So I like that. The other thing that we're not seeing here that was slightly concerning, right, is that you had this inside bar that in theory could have rejected, if we just zoom out here on the weekly. Remember that inside bar, if we broke down below it, and it triggered, right? We sort of had the possibility, the threat was there to come back down underneath the top end of this major balance range from in the past. That's simply not taking place, and this break to the upside this week gives us a little bit more leeway to say, okay, is it possible that the Russell is going to hold this? This is really, really sloppy at this point. I would not really consider this a huge monthly higher low. Remember, we had monthly higher lows here. This is kind of a monthly lower low. But is it possible that the market's trying to make a stand here in small caps? I think the answer to that is somewhat yes. Another consideration here is that into the end of the week, which is primarily when the Russell broke out, let's quickly go through the VWAPs and then I'll tell you what I'm about to tell you. Anchored VWAPs above the entirety of the stack. Remember, there was some threat there with the doji / inverted hammer last week. So that's been cleared up. That's a reinforcing data point. And I think if you're taking away anything from this analysis, looking through the IWM here, it's just that we're not shorting the S&P. Right? We're not, we might be cautious of the new highs in the S&P, but we're not short the S&P with this broad Russell moving in the upward direction. You can see we're well above the Fib 38.2. If we come in from the high, have we yet recaptured? Yeah, not quite. The Fib 61.8 is the next major hurdle for the small caps here. If they could get up and over something like 217, that would be a little bit more of a compelling story. How about from here? The lower high pivot to the low over the Fib 61.8 there, that's it's a step in the right direction. Let's label it as that. It's not, oh my God, we need to be at new all-time highs, but it's a step in the right direction. Let's go ahead and take a look at the volume profile, and then again, I'll get you that information about the components of the, I think I grabbed the wrong study there. Let's go weekly volume profile. We still have this massive overhead node that we have to contend with. We are kind of in the low volume void. We've just closed ever so slightly inside of it. So the best rotation here would be if small caps can get follow through. Once again, that keeps us from shorting the S&P, but we still might want to be cautious about just buying the highs if the NASDAQ starts to pull back. So think about this from a rotational perspective, right? Let's go ahead and drop this down to a daily chart. And on IWM, we finally brought out the daily set here, a little bit cleaner. The upper and lower edge of the weekly expected move, you've got 217.17 breaching the daily 200 and also closing that low volume void overhead. You've got here at 206.63 on the downside, implying a daily higher low. Lows, higher lows, soft higher low, firm higher low, firm higher low, soft-ish higher low. That could be a firm higher low if the hourly trend flips to down. Now, would that be ideal? Probably not, because you can clearly see now from this daily perspective, the inverted head and shoulders, we really want to stay over the neckline, right? We've consolidated enough in this right shoulder. Staying over 209.75 is sort of the next key. We did get a daily hammer. Let me zoom in a little bit further on that for us here. Daily hammer on Friday. As long as we go gap fill reversal, if we take out Friday's high, we are looking for follow through in the upward direction on Brigade bolts, basically over the neckline, right? It would be fine to see extension here, pull back off the daily 200, get the Brigade bolt higher low here, then look to extend the gain in the upward direction to really retest the origin of the breakdown from back in the February timeframe. So what was I going to say? It was all about the components of the small caps, right? You're seeing a lot of small regional banks in here, financials, as well as energy companies, small energy companies in the Russell 2000. Now, why is this important? Because on the Friday session, the reason, in my view, that the Russell moved so substantially higher is because we got that beat on the labor report, right? And the unemployment rate remained somewhat stable, and interest rates did what? Well, the Fed's probably going to keep rates higher for longer, which benefits both financials, and energy sort of moves in tandem with interest rates as well. So considering the composition of the IWM, it does not strike me as like this huge head scratcher. Why all of a sudden is the Russell breaking out? That's sort of your answer. It's the pre-market data we got from the labor report on the Friday session. Let's go ahead and take this thing down to the hourly time scale here, and see what else we can learn. It's kind of fractal in a sense where you have the daily inverted head and shoulders and the hourly inverted head and shoulders. So it's the same exact context where if you were to pull back, gap fill reversal ideally stays over this micro neckline. So again, 209.75 does not change. Would I be bearish if we were to do something that looks like this? Wouldn't be the best look, I'm going to be honest. We would not really want to see it turn into a failed breakout, but if we can catch for support around 206 and really just avoid basically getting back down into this range, you can see I've still got this labeled as the major lower high threat. That's that weekly top end of the balance range we saw way off to the left. As long as we avoid coming back down into this range, I would still say that 206 can yield lows, higher lows, and possibly a higher low, especially pulling back from the highest high. Remember that all of these were just kind of equal highs. Right? So a pullback here kind of keeps your hourly trend intact. Is it the best one? Not really. You probably want to be above it here, perhaps. Lower edge of the weekly expected move, 207.75, 206.63. So maybe not a full test of 206. I'm much more of a fan, you guys know this, of the horizontals than the diagonals, but in this case, perhaps we look to Thursday's low and this previous pivot high to act as your next key hold instead of a full rotation back down to this 206, right? So that is your small caps. We can come in with the fibs off the lows up to the highs. And what we see here is probably a similar conversation, right? If this is a way better pullback than going all the way to 206, just purely based on a fib. And if we come in from here, do we get confluence at the top? Not quite. I was looking for maybe a fib 38.2 right at the 209.75. We're not all the way there. I think if anything, the fib 61.8 would just reinforce that this is absolutely at 206, a little bit more of a line in the sand. Let's quickly check the anchored view apps intraday. We're above the entire cluster, and again, confluence here would build a pretty compelling argument for 207.75 acting as an hourly higher low. Let's check in on those preloaded market internals for the Russell. Strong volume inflows on Friday supporting the breakout that we saw in trend higher zone for a decent chunk of the session, about half, but still closing pretty strong on the advanced decline line. The cumulative build not really doing much of anything impressive there on that Friday afternoon, sort of flattening on some of these big, pushes, if you will, sub-zero. So paying attention to that, but as long as we're over the key technical structure, I do like the volume that's flowing in there. I do like the advanced decline line. Obviously, that's going to be the case on a day where you gap up in the Russell. What else was happening earlier in the week, though, with the advanced decline line? Again, Tuesday being your primary breakout day, you are getting confirmation out of that cumulative tick, and you are getting it here in the volume flows as well. With that, let's go ahead and move into the market profile for the Russell and see what we can see. Zooming out a little bit, let's get that Monday session on board. So obviously value is going to be higher on Friday via the gap up, but where is it on the Tuesday, Wednesday, Thursday? What I was sort of concerned with on the Wednesday video, you even heard me say this in the midweek market update, was your upper wick and A period single prints and sort of your value area low. Not really perfect mechanical level. I mean, value area low is technically in here slightly. The low is technically here. But the threat would have been on Thursday. Breaching these lows could have brought in a firmer retracement to the downside. And I guess the follow-up analysis to Wednesday's video is simply that you broke the lows absolutely on Thursday, but look at where value is, look at where the point of control is, and obviously it got follow-through on Friday. So do we see sellers or even buyers who are like panicked and, oh my God, we should unload everything in small caps on the breakdown there on Thursday? The answer is no. And once again, it's not sector rotation, but in terms of maybe market cap rotation, if you want to even frame it that way, you are seeing small caps holding that bid, which is not really bearish. And even if this pulls in a little bit, I think you have an excuse, or pulls in or extends to the upside. You don't have stronger sellers here who are going to influence the S&P all that firmly in the downward direction. So that is it for the Rusty Rut. Let's go back on over to the platform here. Let's take a look at our sectors. Now we'll talk about sector rotation. Who was leading, who was losing, and where was the weight on the weekly view? Well, semiconductors lead the pack up 5.67%, followed by the tech sector, then communications, all outperforming the S&P, up over 3% on all three of those sectors. At the bottom end of the barrel, it's consumer staples, it's consumer discretionary, primarily due to Tesla, and then it's utilities. If you wanted to strike from the list consumer discretionary and look at the next laggard, bonds are not a sector, but then you have energy down here at the, it's still up, but it's lagging. It's only up 42 basis points. To me, consumer staples, defensive. Utilities, defensive. So as the market tries to rally in the upward direction here, are you seeing follow through from the sectors that should be pushing the market higher? The answer is yes. And that means, right, if we were to see a pullback in semiconductors this upcoming week, do we see the rotation back into names like staples, utilities, energy, materials? And does that fuel the market higher? It's very possible. The posture right now is certainly risk on. Let's check out the sectors themselves. Obviously, semiconductors, we talked about this all week. the 249 level. As long as we're above that, it's very difficult to maintain any sort of bearish stance in the market here. So the Friday bar is not all that compelling. You do have an inverted hammer there. If it pulls back and supports over 249, it's a great spot for a higher low. I'd be a little bit more concerned if we fell into the balance range, lower high, and then rotated all the way to the bottom. Certainly look above and fail, but we'll take that when and if it happens. As of right now, we're still over that 249. So that's your key watch on the semis. If we take a look at the tech sector, it's a very similar picture where you've got your balance range, you've got that extension over it. You could even say that on the Thursday session when the market was like totally just wrapped up in the Elon Trump drama, where did the market hold, right? You've got sort of a catalyst. You've got this massive downside move on Tesla. It was down over 14% intraday at certain points. The market was still holding in the tech sector all up at 235.75. So once again, I think to me, that would just indicate that the Tesla drama is sort of an isolated incident and the market's not over-indexing on that panic. If we take a look at communications, nice breakout here over the 102.70. Just ask yourself the question as we go through these sectors, is there room to pull back for a higher low? The answer is yes. Right, as long as you're over the breakout high, consolidation, extend the gain, pull back, I mean, no problem. If you come back down into range, we'll have a different conversation when we're in range and see what that looks like for the S&P when it's taking place. But for now, we're not really seeing indications of that. There's the S&P, speaking of the devil, and here's industrials, brand new all-time high. Tough to be bullish on a brand new all-time high. Not the most compelling daily bar, but location-wise, right, plenty, I mean, I wouldn't say plenty. It'd be best if you stayed over the all-time high now that you've broken it, but you could still, in theory, pull back, consolidate in here, build out kind of like a sloppy, mild trend line like this. I could see that being reasonable. I would be more concerned about the industrial sector if it were to drop and do something that looks like this underneath the balance range lows. If we were closing this gap, okay, now we're talking about threats to the broad market, but this, as of right now, no problem. Not overly concerned about it. Let's look at healthcare. A little bit of a bid here into the end of the week, getting some uptick. Still just inside of this balance range. It's hard to say anything constructive about it. As long as it's not breaking down through 129.25, I don't really see an issue with healthcare here. Let's move along to financials. Financials are sideways. It would be best. We've done a little bit of a massage to the levels here. We had one, as we know, going through about 50.70. 50.40 is more of a reflection of the bottom of all of these equal lows, which poses the threat, right? If we were to see a breakdown in financials, it would have to be underneath all of those equal lows to flush the hands of the buyers who are getting involved here, and now we have a concern. As of right now, consolidating above, it's very difficult to say anything really constructive or bearish about the chart here. If anything, I would say maybe on the weekly time scale, right, you're starting to get a little bit of a look for bull flag consolidation, seeking some follow through perhaps from the classic pattern perspective. If anything, I like that this consolidation is over this previous pivot high. So I'm not bearish here on financials. Looking at real estate, not much to talk about here. It's one of the lightweight sectors inside the range. New pivot high becomes interesting. Upward pressure would be upward pressure. Materials, similar story. It did breach the range in the upward direction there. So it's acting as upside pressure, but it's not going to save the day in the S&P 500. Energy, no sort of movement on this. We're still just stuck in this range. Although with interest rates moving slightly higher, we might expect, again, these things are highly correlated. So higher rates, higher energy. You could use crude as well as a proxy. Let's go CL. Let's see what we got. Did we break? Yeah, we're getting close. I mean, I'd say we're over the neckline of some sloppy, some interpretation of a inverted head and shoulders, maybe a double bottom with a higher low. Call it whatever you want to call it. Doesn't matter. But the breakout here in crude, right, probably coinciding with higher rates, probably coinciding with energy moving higher, generally speaking, helps that IWM, which is comprised of some of those smaller companies, right? Let's move into TLT. Let's see what's going on with the bond market. The bond market, not too happy with the labor report on Friday. Of course, that's just on the premise that Powell is going to keep rates higher for longer, and the long end of the curve is also acting on that information. So not a shock. I would be, here's a tidbit for you. I've wrapped up all of the short put sales that we had on the TLT. Just as an FYI, because this has been a really solid rinse and repeat trade all of 2025, really. If we were to get some big collapse here to new lows, I would start looking to short more puts, 78 handle, 79 handle on the TLT. So we're not there yet, but if bond volatility is going to increase and pick up, I would look to sell some premium on the put side. CPI could be the catalyst, right? XLP, what else is going on in the sectors? Nothing concerning here. A little look above and fail, as it's just sideways in this chop and slop. I don't think you really have a compelling story in terms of the narrative for the broad market. It's not outperforming, it's not underperforming, it's fine. Let's move along to, by underperforming, I mean breaking the balance lows. Obviously, on the week, it's underperforming, undoubtedly. If we take a look at the discretionary sector, not much. Obviously, not, well, I shouldn't say obviously, but the Tesla move looked into the China gap, but supported the daily 200 SMA. You could thank Amazon for, I think, a majority of that. But for now, inside of this range, you can see this very small inside bar on Friday. I'd just be kind of neutral here. I'd be continuing to watch Tesla, obviously, as a heavyweight component there. But if Amazon can sort of undo some of the damage that Tesla is doing for the sector, I think you probably remain stuck in balance. And that might disappoint some traders who are trying to look for a stronger short. If Amazon and Tesla just, in terms of their weight for the XLY, I wouldn't say cancel each other out, but if discretionary is not closing this gap aggressively, not falling off of a cliff, you're not going to get a big downside move in the S&P, paired with semiconductors holding over the balance range. Same thing out of the tech sector, communications, brand new highs, right? It's just not going to happen. So Tesla, isolated incident for now. Utilities, D for defensive, trying to get the Brigade bolt here, again, over 80.25. If it happens, fine, no problems. It's a higher low. It keeps the trend intact, but it's not pressing new all-time highs, so I wouldn't call this a concern rotation-wise for the market as a risk-off signal. Speaking of risk-on-off signals, let's take a look through our ratios, which are a little bit cleaner of a view for that. If you're not familiar with ratios in Thinkorswim, check out the video tutorial in the top right-hand corner. XLK continues to look really stable and solid here as a ratio to the S&P. That does not look bearish to me. This could use some improvement. Obviously, the big downtick happening on Thursday with the Tesla spat, if we want to call it that. Financials could use some improvement. I'm going to put a neutral tilde here as well. You're not seeing outperformance from the XLV healthcare sector. You're also not seeing outperformance from staples or utilities. So it's difficult for me to look at this grid here and say that risk off is the overwhelming theme of the market. It's simply not. We can see that as well in the specialized ratio grid, tech versus cash, basically, risk on. Tech versus utilities, risk on. Semiconductors, healthcare, risk on. You can see here discretionary versus staples, risk on. Still in a mild pullback, but it's definitely not breaking down. This I found really interesting. ARKK, so the innovation ETF, ARKK, big breakout on that Friday session. Look at this thing in the upward direction. That is, in and of itself, a risk on signal. But if you look at it relative to the S&P 500, if we go back to the flex grid, the ratio itself is also breaking out in a major way. If you look at, this is the broadest measure, we added it just a couple of weeks ago, IWO, Russell 2000 growth versus IWN, Russell 2000 value, risk on versus risk off, a proxy for that, right? The trend is clearly in the upward direction. So one more time, as we peer through these different sector charts, these relationships, it's not a big short in the S&P. We might be cautious of buying the high with poor location, but it's definitely not a short. As we look at the TLT ratio, this is gold. TLT ratio to the S&P is down here. It's still risk on, right? It's rolling over towards the lows. That would speak to risk appetite for equities. Same thing happening here in gold. That's the one in the top left. You can see a little rollover happening here. Bitcoin, it untriggered the Sailor Shift tool on the Friday session with a little bit of a rally that we saw there. I mean, you could, in theory, get a higher low that is not a firm test of 92,000. There's nothing wrong with just consolidation here, but the untriggering of the Sailor Shift keeps me a little bit more optimistic, right? It would sort of prevent us from wanting to be short on a close underneath those prior 2 weekly bars. If I zoom in here, let's maybe go full screen Bitcoin. We'll give it some love today. These two inverted hammers, right? If this closed red here and we got a weekly close below the level, now we're talking about a pullback to 92,000. That's not the case right now. And what that would signal to me is just continued risk appetite remaining elevated. There's no reason here for seemingly, Bitcoin. Point being, what I'm trying to say, let me pause there for a second. What I'm trying to say is, as a risk asset, Bitcoin not breaking down aggressively under these lows, triggering a weekly pullback to 92,000, strikes me as being fine for the broad market itself. There we go. The brain fart is over. Let's take a look at some continued evidence here. Dollar getting a little bit of a bid as interest rates, of course, moving in the upward direction on that stronger than expected labor report there from Friday. I still don't see a big issue with interest rates until they're over 4.8. If you've been tuning into the pre-market preps, we've been reinforcing 4.8 for a very long time. The reason being is if we look at a weekly chart of the interest rate, this is the 10-year, right? You would really need to break out over that to start targeting maybe something like the 5% mark. Do we have issues when 5% hits? Probably. I mean, if you're talking about everything going on the fiscal side of government administration, the whole 9 yards right now, yeah, that's going to be a big deal, as and if interest rates start breaking out towards 5%. But for now, we're still contained underneath that 4.8 lid. I think maybe you see it in the headlines a little bit. Scott Bessent, the Treasury Secretary, right, might start to come out and say something, try to ease the markets, cool the markets off a little bit towards 4.8. We'll see, but for now, not really overly concerned with rates. Let's jump into inverted ZT, which is, of course, the 2-year. It's going to be as close as possible to the Fed's measure, and it's on an uptick here. So what does that mean? It means that those cuts probably not coming as soon as the market was expecting prior, based on the stronger than expected labor report from Friday. If we take a look at the Fed Watch tool here, you can see that. As a matter of fact, on Friday, this was actually reading at certain points around 99.9% odds of a pause for the next meeting in June. We're not shocked about that, but what we do want to read into is just the idea that, remember, there was the second cut was being priced into the October timeframe. Remember, it was September and then October, and then it was a double pause at the 375-400 into the end of the year. So the market is unwinding some of its expectations of that cut sooner rather than later based on the strong labor report. If you want to take a look at it, here it is. Technically, unemployment rate remains really stable there at the 4.2%, which is it's historically low unemployment. We'll continue to say that. It's higher than what we had here coming out of the major sort of reversal out of the unemployment rate, but it's still historically low. If you look at the NFP, so this is jobs added to the economy, you're seeing a majority of that here in the education and health services. The one thing that I find maybe worth talking about is here, where your professional and business services, manufacturing saw a little bit of a contraction, right? That's the pink slot down here. Typically, right, that might be some of the higher earners. It's one way of viewing it. I'm not saying it has to be that way all the time, but maybe pay attention to credit card spend here if those folks start getting laid off from maybe some higher earning power positions. So worth paying attention to. Let's take a look at the Beige Book up next. This was released on Friday or Thursday. I can't remember which day. But why this is important is because it sort of gives us this final line here, which is not anything that nothing dramatically new. We knew that Jerome Powell was sort of looking for impacts from tariffs based on his previous comments about one report doesn't make a trend. We probably need, 3 reports, give or take, before he has a firm grasp on maybe what the impact of tariffs are. There you go, 3 months. So 3 months from when all of this was kicking off. So April is when they go into effect. We start to see that data roll over in May, right? And then June, July, probably August, September, really more like September. The Fed has the end of August, early September is when the Fed has a grasp on what price increases are going to look like and if inflation is really going to get out of control. And speaking of inflation, the reason I bring this Beige Book up is because we do, of course, have next week the CPI inflation report. So we will be live up in the Penthouse office for our pre-market prep at 8 o'clock. The numbers come out at 8:30. I hope you can join us for that. We will have coffee and donuts. That's on me. I will supply them. If you want something other than donuts, bring them yourself and bring enough for everybody. But 8:30, CPI is looking at a 0.3 on the core month over month, 0.2 non-core, and a year over year at a 2.5. Just to give you an idea, again, here's prior. They've actually conveniently listed it for us. The market's looking for a little bit of an uptick from tariffs, but probably nothing that's substantially going to alter the course of what the Fed has sort of been saying right now. It's not really a blowout read to the upside, like where, oh my God, we're expecting a 0.5. That could sort of be coming down the pipeline in July or August, perhaps, if things are really going to accelerate. Remember, the Beige Book is a survey, basically, of nationwide what's happening with different businesses and what economists are seeing. And so this prices segment it's the result of conversations with many different businesses, right? And that's the nationwide highlight, not the highlight by district. So if we just scroll up, national summary. All right, let's continue along with the earnings calendar. And of course, just to continue along, PPI is going to be released. You should definitely pay attention for that on Thursday because of the blend of CPI and PPI, which makes up the PCE, which the Fed uses as their preferred gauge of inflation. And then down here, definitely be aware this is always market moving, consumer sentiment and inflation expectations. This has been unbelievable, like off the chart reads out of the preliminary reads from the University of Michigan Inflation Expectation Survey. Friday morning at 10 o'clock, it will be market moving. It has been for the last number of months. Let's take a look at the earnings calendar. It's pretty quiet out there. Last week it was pretty quiet as well outside of really CrowdStrike and Broadcom. This week it's going to be Oracle and Adobe. Maybe look out to Restoration Hardware as well to see if they're seeing slowdown considering the price point of their items. And that would sort of pair nicely with what we just saw over here. If these are the higher earning power people, if you will, it's very possible that Restoration Hardware starts to cite, hey, guidance going forward is not really going to be looking so good, or we're raising prices and nobody's buying, right? That would be the worst possible outcome there for Restoration Hardware. No pricing power out of the company. Let's go back on over to the platform. Let's finish up our broad market analysis with some more supporting evidence here. Bonds relative to themselves, pretty stable here still through the short end of the curve, the high end of the curve remaining elevated to combat against inflation. No issues there. Let's come into credit spreads. Continuing to drift lower, That's bullish for equities. If we look at junk bonds in isolation, a little bit of a negative divergence happening here, bearish divergence, end of day pullback here versus flat in the S&P 500. You could sort of pair that with some of the other things we've been talking about today, which maybe keeps us from buying the all-time, or not the all-time high, but the newest high, the highest high in the trend count in the S&P. If we move into our total breadth, here's another subtle bearish divergence in the sense where, yes, we're pushing to the upside here. Yes, we're slightly higher here, but let me bring this to a daily chart. Let's go to a 3-month daily chart. I'm going to do the same thing down here in the S&P equities chart. And hopefully with a little bit of luck, we'll be able to see this. Maybe the RSP definitely shows it, but what I'm pointing out is, notice as I draw a flat line across the SPX, we're obviously sitting on a higher high. We saw that in the SPY analysis as well. Well, look at what you have happening here. Subtle little bearish divergence, subtle little bearish divergence. Now, these are not underneath the 50% mark. These are not saying like, oh my God, markets should be at zero. We are still technically getting more new highs versus new lows. So it's not a bearish call. It's just a, hey, let's be cautious and mindful of our risk type of heads up. It's a warning, really, before we just start going all in at the highest high of the trend count in the S&P. You can see that here as well in the RSP. So your equal weight S&P 500, lower high versus the higher high you're seeing in the weighted SPX. If we bring out the NASDAQ, you're seeing not quite the same. The weighted NASDAQ has been much more in sync with the equal weight NASDAQ. So there's no issues here on this particular chart. Let's jump into our volatility, VIX, and see what's happening there. A little bit of a downtick in vol to be expected on the release of a labor report like that. The cat's out of the bag. Everybody's comfortable and okay, all set. The labor market's not imploding and jobs are being added. It was better than expected. Not really shocked to see the VIX lower here. Let's go VVIX in the bottom pane. Same exact thing. If we take a look at the vol futures, strong contango here. The curve is absolutely pointing in the right direction. If we just go VIX, and then take a look at the curve for those folks who are not aware, right? We want to see this style curve, depending on which way you're looking at it, convex, concave. What we want to avoid is this. This is telling us, whoa, there's a lot of risk right here, right now, and there's less risk in the future. So money managers, what do? They're like, all right, let's just hang tight, remain patient. No need to allocate capital here. Let's wait for the future. This is like, nope, everything's fine right now. Let's allocate, and in the future, maybe things get worse, but we can't make a bet based on that, right? So that's your VIX curve all set there. You can even see it in the 9 versus 30-day VIX with the subtle uptick in the upward direction there. 1-day VIX also, what we had talked about on Wednesday, right, was we made a new lower low in the 1-day VIX. We got that little uptick on the Elon spat on Thursday, but on that Friday release of the labor report, we're right back down comfortably in the midpoint of this range. So volatility doesn't really strike me as a large issue here. Let's get into the core list of companies. Let's see what's going on with NVDA to kick things off. What's going on with NVIDIA? Certainly an equal high breakout point is brewing here at 143.25. I do like the fact that this bull flag has basically broken out. And for the most part, I mean, yes, there was this overshoot, but for the most part, the acceptance is over the top end of the flag range at 137.15. So walking forward from here, I think the trade setup is very simple. You're just looking for that Brigade bolt over 143.25 into 149.25, and that's a very lucrative range to trade, something that NVIDIA could do over the span of 1 or even 2, maybe 3 days if it's a grinder and it's completely contrary or divergent, I should say, to the S&P 500 broad market. So 143.25 is a top watch on the hourly time scale. You don't really learn anything new here. You're just continuing to see that consolidation, and so long as this really acts as, I wouldn't go out on a limb and call it a cup and handle, but it's undoubtedly higher low consolidation. I would say that this is fine. This is even A-okay. I would entertain that because this to this is the last major higher low. This consolidation never really flips into a downtrend because notice, you're really just coming from the equal high. This is hardly a lower low. I would give NVIDIA the benefit of the doubt still over that 137.15. So show me this. Great, fine, no problem. I don't really want to short this. I would rather wait for the long off of 137.15 and then continue to Brigade bolt higher, 140.50, 143.25. If NVIDIA is going to roll over and completely collapse and like it's going to be horrible, honestly, I don't even like trying to short it through some of this chop and slop back here. It's very similar to the NASDAQ in some sense, right? And the best short is really this. Like, start closing up some of this thin structure breakout on the way higher. That's where the short is. That's under 129, which clearly there's ways to go. Let's take a look at Microsoft, brand new all-time highs. Microsoft acting as a little bit of a leader here as well. If we think about the daily structure of the bar, inverted hammer is not the best looking idea, right? If we were thinking about longs here, the consolidation is fine over the previous all-time high, but it's got to show me this with momentum. It didn't really get momentum. Like, this entire grind in the upward direction has almost been momentumless. So for that reason, I got a love-hate relationship with Microsoft at the all-time high. Obviously, there's relative strength here, but intraday, it's kind of been a tough one to trade. So we'll take that for what it's worth, over 468.35. It's hard to be a bear here. If we do breach the low, I would think that a pullback deeper towards this 462.65 is the next major daily higher low, right? Something that looks like this. Fine, no problem, back to all-time highs. If we do this, that's where you have some pretty big red flags, white flags to start, red flags to emerge on a lower high beneath that level, 462.65. Next up, Apple. We brought it up in the very beginning of the show. It's almost dead. It's almost dead to me. There's really nothing going on here trade-wise. It's still a really heavyweight component of the S&P 500, obviously. We don't want to forget about it. Like, if it ever does make some miraculous move to come up here and close the gap, maybe there's a trade at some point, but intraday, if you've been watching it, you just know that there's really nothing going on here with Apple. It has not gotten in gear. Obviously, you've got the innovation concerns that people have been talking about for the last 5 years. You have the tariffs and the China manufacturing. That's kind of a big issue right now. It's tough. So let's just move along. Amazon. What's going on with Nancy? So nice little curl. That's, a lot of people talking about this curl here. It's definitely a higher low curl, clearly, something that does this. Higher low. To the left, though, what do we have for structure? We've got over 214.50 into 219.25, perhaps. I would really be okay with, if we get a better higher low entry here on the daily, because remember, the daily certainly made the equal high. That's fine. If we were to get here on the daily, I'd still entertain, this kind of deal back to the equal high. The best thing on the hourly chart, so like short-term traders early on this week, just want to see persistent consolidation over the Thursday high, over that upper wick, right? If you could hold that at 212.50 and Brigade bolt here, that's probably where the lucrative trade starts to come in, 214.50 to 219.25. If it does pull back, must hold 206.50. It's kind of the line in the sand there. Let's move to Google. Look below and fail is playing out kind of nicely to some sense, right? You have inverted head and shoulders kind of there. Over the neckline with the gap up on the Friday sessions, getting the follow through. Next stage is really getting that acceptance over 174, so some sort of Brigade bolt there. I would say this thin structure is worth paying attention to. It's towards the upper third of the range. If you were to just divide this real quick, maybe something like this. Our levels are pretty close, but not exact. Over 174, it's correct when it comes to structure, not perfect thirds, is what I meant to say. So I'd still use the levels, right? Don't use perfect thirds. Over 174, top end of the range becomes the target, 176.75. If it's just, rolling over towards the daily 200, I don't really love it in the midpoint of the range. Remember that your edge always exists at the edge. You get breakout, mean reversion. You get the same thing down here. That's mean reversion. This would be breakdown. Okay, so that's Google. Metaverse has been absolutely on a tear. Huge upside move happening here. If you look at the daily chart first, big push. You're basically home. You're at the level, this 704.50, which is really the origin of kind of the big breakdown here. This is where it was on a tear back up to the highs. This is kind of the nail in the coffin, the acceptance back below, and okay, obviously it rolled over from there. So 704.50 is pretty much the origin of the breakdown. I wouldn't be shocked to see Meta start to cool off here. I would love to see consolidation in this zone on the daily to then build out something that does this. This is kind of a thin structure retracement over the 704.50. The daily bar on Meta sort of gives us the idea that maybe that could take place because it's got that upper wick. There's some early signs of rejection at the 704.50. I wouldn't just start shorting this thing. I would still maintain the bullish stance on Meta, even over 661. Obviously, on the daily time scale, there's your Brigade bolt, right? Where do we get involved at 661? Well, if we can get a higher low there on the daily, hourly reversal of the trend, no problem, 661. So on the hourly, let's take a look. right? That kind of looks something along these lines. If this comes in, maybe we get some scalps to the downside. I'm not saying you can't scalp that in there, but first thought is like this consolidation is perfect. Can I buy this first and go back to the highs? If we drop it, maybe there's that scalp. I would go here and then here at 661. How do we get involved back in the upward direction for that DHL shipment daily higher low? There it is. Okay, Metaverse done. If we were to get consolidation over 704.50, I wouldn't fight it. I wouldn't fight it. I would not try to force the issue on a short. Tesla, everybody's favorite as of Thursday's breakdown. I want to start on the weekly chart actually for Tesla. Let's go here and let's go weekly. Tesla came into a very interesting weekly spot. In transparency, it was a decent ad spot, I think, at least on the longer term accounts. I mean, you've got this weekly inflection point. If Tesla is going to hold up over the 272, 275 area, seems like a decent spot to add long-term shares. You're still in a long-term uptrend. You could strike a trend line from here. You could zoom out on this thing. I mean, depends on your outlook and how you feel about the company and AI and robotics and all that. But if robotics and like the Optimus robot, you could think of Tesla as an intelligence company too. If we're still in like early stages of that, and I would say we certainly are, you don't have robotics in everybody's home just yet. I mean, to me, it makes sense, right? You're sort of dealing with some degree of risk maybe here underneath this pivot low for not just back up to the all-time high, but continuing compounded returns out of Tesla. So we'll see. We don't want to like, it's way too early to call that a victory, obviously, but it seemed like a reasonable spot. Anyways, weekly. If we can understand that from a technical perspective, it's a reasonable spot, then let's go to the daily. And what do we see there? Well, of course, lo and behold, it's the low end of the flag range. We're still over as of the Friday close, the neckline of the double bottom. If we could stay over 293.50, I think that this is a great spot for just daily or even weekly. It's not really a daily because you've reversed the trend on the daily here via head and shoulders. It's a great spot for a weekly higher low. If the weekly can persist there, then fantastic. And really the next phase is, can we get the thin structure retracement? And then we do battle at the neckline. That's back up at 334. If we can get that, then fantastic, right? The next look would be, okay, maybe a pullback, higher low over the moving average cluster, if this looks something like that, and then back into the range. That's kind of how the chart develops from here, in my opinion, if it's going to reverse higher. Now, Friday's bar is not like the most rainbows and butterflies bar. Any sort of breakdown underneath Friday's low should bring in the equal low, right back down into that 270, 275. It's an inside bar inverted hammer with confluence at both sides of the moving averages. Here it is on the hourly time scale. If buyers were going to make something happen, you would think that being back over the opening print, right, probably should have looked for something like 311.25, the scene of the crime, where the larger breakdown really emerged from. It just didn't happen. So neutral until proven otherwise, until this bar's range breaks on Tesla. We'll learn something here, 311.25. We'll learn something underneath 293.50. Moving along to finish up the core list of companies, JP Morgan sideways in range with financials. Really not much to talk about here. So if you're bullish financials, you got to get some clearance 266.50. Maybe we get this thin structure retracement being interesting in the future, but for now, not much to really talk about there. If we look at Netflix, it's one of those new market leaders pushing in the upward direction. I would say higher low pullbacks fly over 1210. Daily higher low pullbacks fly over 1210. Good to go back into 1260, and that is your upside on Netflix. Wouldn't really be a short here on Netflix given some of its strength, right? It just doesn't make sense to try to short one of the strongest names in the market right now. So when I said I had 3 ideas to share with you, I meant I have a handful of charts to go through. There's really nothing that piques my attention in a way that's like, oh my goodness, this is a great setup. Let's call it out individually. So we'll go through the enCORE list here. It's some of the usual suspects that we trade in the periphery of the core list. So Broadcom, we talked a little bit about in the beginning. The daily bar would seem to me okay to look for pullbacks here, 234.25. I'll be watching for that on the hourly chart. You can see, right, we did start to reject the previous all-time high via these upper wicks early on in the Friday session. Thin structure retracement on the hourly, 242 is the first target. Daily, all set to here, right? We just talked about that. So hourly, if it supports above, then your next sort of look is probably this higher low here. Versus if it makes it all the way to the daily mark, then we could probably look for this with tight risk and reward, ultimately looking along those lines. You know, that's the range you're trying to exploit basically, but one step at a time. Let's not get crazy, of course, right? You'd have to go here to here, right? 1 and 2. and then 1 and 2, and then so on and so forth. So Broadcom on the pullback is still interesting. It is one of the stronger names in the market. It's the first semiconductor back to all-time highs. Speaking of semis, let's take a look at Taiwan. Anything interesting out of this chart? This is going to be your next upside level, the opening print of that bar. Let's go to 1325. Getting a little bit of a flag breakout if you're to consider it this way. So upside target is definitely in play at 213.25. It's just, again, do you want to chase it here towards the highs as it seems to be running out of momentum? The idea would be as long as we get acceptance over 204.75, you'd want to stay long. You might have to start buttoning that up if you were to get a break of like the trend line here. If you were to start coming back down underneath 201.85, it would seem to me that the gap close is the next priority at 198.50. If we were to go back to 198.50, well, lo and behold, you've got a Brigade bolt. I would certainly be fishing for longs off of that level. So if you're not already long, this location is not really ideal. If you're looking for the pullback, it's the gap fill reversal, and then back to the equal high, and then beyond that into that 213.25. ARM, anything interesting on ARM? Just going through the enCORE list here as some additional ideas. Not much until you're out of this flag range. Even that is 144.15, this breakdown back here. I think it's not one of the hot names right now. Broadcom is definitely it. NVIDIA is definitely it. Even AMD was getting a little bit of love here on this push over the hammer high. This is a double bottom. This is your neckline. As long as you're over 115.85, next key break is over 119, and you're probably looking for the daily 200 SMA. Here it is on the hourly chart. You could see, right, this is just an upper wick back here. I wouldn't cherry pick the wick over the actual structure at 119. There's your daily 200, 125.50. Let's take a look quickly at Coinbase. Coinbase, I still have an alert. You can see it here. 242, give or take, right around this area. If this is going to be like a rolling top, and this was really more so in play when Bitcoin was looking weak with the Sailor Shift tool signaling a bearish outcome, I'd be interested in consolidation here to possibly close the gap to the downside. 231.25, 213.50. Still an idea that's in play. I'm not really interested in trading Coinbase in this range. Be my guest if you'd like to. MicroStrategy, a little sloppy around this level in here at 373.50. If you look at the daily chart now, you've really just turned this into kind of a range. What was a tighter range, good for a day's breakout, now is just kind of a larger range. You've got to resolve here, got to resolve here. Let's take a look at Palantir. We talked about it in the beginning. If it is going to be a double top, you need to be under the neckline at 121.25. If you look at the hourly chart here, to me, you've got some threats. I think that Palantir could be an early week watch for a possible hourly lower high, because the daily trend is now neutralized, right? You have daily highs, equal highs, lows, equal lows. Daily trend is neutral. Hourly trend is flipped to down. Is this going to be a 1 hour lower high? I would certainly keep an open mind to that at 127.15. If it rolls, you've got thin structure, right? What goes straight down, goes straight up, can probably come straight back down. 127.15 down to 121.25. We'll finish off with CrowdStrike here. What do we see on Crowd? This is the key hold, right? You've got your daily Brigade bolt there. The next key watch on CrowdStrike is what happens at 473.25. Recovering from the earnings gap down, seeking some sort of Brigade bolt here. Equal high target at the all-time high. You've got 489. Let's go 490 on it. Round numbers. Let's go round numbers up here in the office. There you go. The last one I'll just kick over to is if we go to the new market leaders list, we've got most of these covered, but let's go to Robinhood. Disappointing for sure. A lot of folks on the failure to be included in the S&P. So I wouldn't be shocked to see this retracement here. You've seen, there's an alert there for a reason. I'm certainly interested in watching the reaction from Robinhood at 66.35. So any opens on a gap down here that reject 71.50, call this sort of like a double top neckline. Below that, alert gets triggered. I'm interested in possible longs there. Do we get daily hammers? Can we add to longer term positions? Does it make sense for an intraday trade? I mean, Robinhood, a lot of eyeballs on this stock recently. Very worthwhile in terms of watching at that level. What else did we not cover? Maybe Uber. Uber's daily chart, weekly chart looks great, right? We've talked about this quite a bit. If we could continue to hold over this, look at the weekly hammer. Weekly hammer here, if we can break back over the high, I would think equal highs on the weekly. So those are some additional ideas that we've covered. I'm not really interested in trading CoreWeave here. Let's go to a daily chart real quick. Inside bar, I would think pullbacks to this range maybe get interesting for some congestion. I'm not really thrilled with trading it. It's just too much of a shiny object syndrome right now for me in particular. But these levels you see here, they're mild levels. If you look at the hourly chart, they're not like the strongest levels we've ever seen. The chart's hardly developed. It's brand new IPO. But these are sort of some of the zones that you might pay attention to if you're interested in picking up the levels. All right. That's all I've got for you in today's episode of the Weekly Watch List. If you enjoyed the video or learned anything new, feel free to let me know down below in the comments section. Again, going through those divergences in the beginning. Was it good? Was it bad? We will have CPI on Wednesday at 8:30. We'll kick off the pre-market prep at 8 o'clock as we typically do. We'll start that obviously on Monday. We're live every morning. If you didn't know, we're live every morning, pre-market prep. Come on out to the channel. It's free. Everybody's welcome. And we'll get the job done. We've also had a fantastic first week launch of the Live Squawk. Live Squawk is the first link that you're seeing down below in the description. It's basically live intraday commentary, calling out key levels that are in play, trade setups that are happening now, trades I'm getting into, what's the context, market internals, what are the sectors doing, what is the market doing intraday, as everything in the heat of the moment is taking place. If you're interested in hearing my voice and continued analysis through the day's session, you could check that first link out down below in the description. With that being said, I thank you all for coming out to the weekend show. We'll see you up in the office on Monday, as we typically do, again, 8 o'clock. Have yourself a green trading week, and I will see you in the next one.